Welcome back, everyone, to another episode of Living Your Greatness. This is your host, Ben Mumme. And if you're new to my show, I encourage you to hit that subscribe button. Today, we have a new guest to the show that I'm honored to have on. His name is Currie. For those of you that don't know Cam, he is a senior investment advisor with CG Wealth Management. Cam has cultivated a deep and high-quality network of contacts within the global mining sector, built on trust, credibility, and his track record of success. Cam also has a passion for geopolitics and a lifelong student of macroeconomics, both which is needed to successfully invest in metals and mining. So Cam, without further ado, welcome to the show. It's a pleasure to have you on today.
Ben, thank you very much for the invite. I greatly appreciate it.
Awesome, Cam. So Cam, let's kind of get kicking here because first off, it's an honor to have you on since I know you don't do these interviews often. So a huge treat for my audience. But just so my audience has a better background of who you are, tell us a little bit about yourself. Where did you spend your formative years growing up? And, what inspired you, to become a top 150 investment advisor in Canada?
That's a full question. First of all, I reside in Vancouver, and I think inherently in the financial world, traditionally that is, Canada being the mining capital of the world. I joined the industry with Canada Rim originally, which became Lorna Dachi. Then we merged, then we bought ourselves back, and then became CG. And so culturally, the firm has always had a very strong base of metals and mining, up till the last few years where we've diversified into wealth management and all sectors. So we're really sector agnostic. But for me, I call myself a metals and mining person, but I'm a value investor. I'm looking for value propositions. And I guess what really got me into this space as a specialist was I saw extreme value discrepancies going back into the late 1990s, early 2000 when we had the first .com bubble. And I looked at the world and I went, okay, the world's so misguided in terms of where money flows are going. And so I rolled up my sleeves at that time and became a specialist in the metals and mining space and got to know the people in the industry. And that was really the beginning of my attachment to the sector. And that's 23 years in the making. And I guess one of my biggest assets and competitive advantages is I have very, very strong, deep relationships. I deal with a lot of senior mining executives. I've been involved with over 9 M&As, merger and acquisitions, and I just, again, became a deep and rooted investor for my clients in the sector.
Awesome, Cam. Well, I really appreciate, that background just for my audience to get a little bit more information. Something that I like that you touched on is, just clearly identifying that you're a value-based investor, right? Almost like Benjamin Graham, he has a well-known book on the intelligent investor. A follow-up question that I have that I'm curious to ask, you gave us a little background of kind of where you're from and, how you got into, the sector. Who has been one of your greatest mentors, that has truly inspired you, to learn from all your wins and losses throughout your investing career?
Well, I have a number of mentors, a number of people that have had an influence on my thought process because, again, I'm not a geologist. I'm a financial person. And so I surround myself with very, very smart people. And then I basically digest the information and then make decisions off of it. But, clearly, Peter Brown, who is the founder of our firm, has always been a mentor of mine. And he's been very much a mining-focused investor. And I learned a lot from him in terms of understanding the street, understanding the markets, understanding people, relationships, and the importance of relationships. And I think that's one of the things that I have now is I have very, very strong relationships with the highest pedigree in the industry. And again, I think the culture of our firm back then was such a mining-oriented firm. By default, I learned so much from his mentorship, his direction, and the culture of a firm that he created, which was a mining firm back then. So it led into so many other mentorships of other people in the sectors. And a lot of the principals I do business with, they're mentors to me too, because they're the knowledge. What I do is I collect a pool of investment dollars and I find the best investment opportunities for my clients. And so the mentorship continues. I got to know the Lundin family in the last 3 years when I got involved with Philo when no one paid attention to that. Again, a new mentor to me. They're much younger than me, but they're mentors to me in so many different ways because they bring a whole girth of knowledge and perspective that I didn't have at the time. So mentorship is continual.
Absolutely. And I think it's nice what you talked about is, there's not just one, there's many. And by
Yes.
having many actually helps us catch our blind spots, right? Having that strong circle of competence, right? Because there are different perspectives and angles that we need to be strong at, right? And you kind of touched upon, like, you don't have the geology expertise, but you know the people that do, and that gives you obviously that competitive advantage over other investors. Another question that I'm curious to ask is, you have such a background that's very strong, right? When it comes to precious metals and base metal space, right? And, I think you mentioned this on one of your last interviews with Jay Martin on his show, but, it's really important for every investor, to include gold in their portfolio. And I know you manage with most wealth firms, 10% in terms of, the gold space. What lessons from history, show us that there's a high probability of gold prices rising in the future?
Well, the time we live in right now, the time we lived in the last 10, 15, 20 years is testament to that. Again, it's not just about gold. It's my observation about the fiscal house of central banks and politicians and governments around the world. And that's really a large part of the thesis. One of the things I point out to people right now, for example, and when we were calling the top of the market 2 years ago, and I was, pounding the table with my clients, telling them the risks of the equity markets in their other portfolio. And I saved them a lot of money because a lot of them, recognize there was risks in the system. And so what gold is, well, first of all, gold is a reserve currency. And I think most people don't recognize it as that, especially in the Western world. And so, you have three large reserve currencies in the world. You have the US dollar, the euro, and gold. The thing about the US dollar and euro is you have a political attachment and stewardship that is obviously challenging today. You have a debt obligation. US just surpassed $33 trillion. And you have a printing press attached to those currencies. Whereas gold has no political attachment, has no debt obligation, and no printing press. So one of the reasons why I've been so steadfast about gold as an asset class in your portfolio is the obvious mismanagement by the politicians and the financial elite of the world. We had a period for 10 years where interest rates were at zero. And Stanley Druckenmiller is somebody, again, a mentor of mine that I read and follow very closely as well. And you hold interest rates at zero for 10 years. You create asset bubbles, and you create bad behaviors and bad investment strategies. And so, global debt went from $200 to $300 trillion in that time frame. Now, just think about that. You had debt go up by $100 trillion on zero interest rate policies around the world, some negative. So clearly, assets got mispriced, and people leveraged themselves excessively. Now we're starting to see the great unwind of that. Now we just saw the biggest percentage change in interest rates in history. And we've seen some early earthquakes. We saw a pension problem in England just over a year ago. We saw Silicon Valley First Republic as the first victims. But these are the tremors, because there's a lot more under the hood here, because we've had people live beyond their means. We've had them leverage beyond their means. And now the reality is starting to set in. Asset prices are starting to decline, and the burden of debt is now sitting on people. And so the argument for gold as a reserve currency, I was just talking to one of my bankers who was just in Beijing last week. Gold premium, physical gold premiums were $100 over spot, because they get it. They're buying gold. The Eastern central banks are buying gold. The Western world is not paying attention to it. And so gold as an asset class isn't just gold as an asset class. It's a reason. The reason is the financial problems that we see that are manifesting themselves, and the protection is gold and gold equities.
So Cam, why do you think the Western world doesn't really see, what, other areas of the world are seeing? Why is that?
Well, I mean, again, love America, and I love the Western world and that democracy. That's the way the world should be run. But you have a fiscal house that has basically kick the can down the line. Whenever there's been a problem, they lowered interest rates to zero. Whenever there's been a problem, they QE. And so you go back to the great financial crisis of 08, and at the time, the Fed balance sheet was like $800 billion. And they ramped up to 4.5 trillion, but they never unwound it. And then, of course, then we had COVID, and they went to 8.6 trillion. And so the average person hasn't seen the consequences of the problem. So if you're inside of that bubble and you're merrily going along and your asset prices keep on going up, and every time there's a hiccup, someone steps in and mediates the financial problem so you can continue on with your lifestyle, you don't see the reasons for having an insurance policy. Whereas if you go to places like Turkey, where the Turkish lira has collapsed here in the last 2 years, you are very, very thankful that you own gold as an asset class, because gold went up. It's gold's trading at all-time highs. And so it's when you go through adversity that you see the validity of owning gold. When you are looking at treasuries at 5% yield right now, and the US economy, people narrative-wise are saying that it's skirting, there's no recession, and we have strong employment and we have strong consumer. The data points aren't telling us that. I mean, just today, for example, they're pointing out car loan deficiencies, payments at a 30-year high. The financial problems are there. It's just the narrative of a strong economy, strong employment are largely misleading. They're also looking backwards. For example, 2 weeks ago, the employment numbers came out in the States. They're expecting 176,000 jobs to be added. It was 360,000 jobs. All of a sudden, the market rallies. Everyone thinks this is great. Yields spiked, gold went down. But the reality is 860,000 jobs were full-time, 1.2 million jobs were part-time, and they treat them as equal. So the part-time jobs are people taking second jobs. So all this is taking place. And so in the Western world, no one's paying attention to that. The Eastern world, is, and then you tack on the other factors, you have a de-dollarization move. And that's the other thing too. If you're not going to own US dollars, what are the reserve currency you're going to buy? And that's why the Eastern central banks are continual buyers of gold. That's why there's premium values being paid for physical gold in China right now, because they see something that's obvious. The Western world is merrily going along thinking that the economy is strong, and it isn't.
I appreciate that answer. It makes a lot of sense because it clarifies that, the Western world is being essentially printed out a lot, right? Or protected, but protected in a way where it's actually not protecting us. It's just prolonging an issue that we're avoiding, right? So a question that I'm curious to ask you is, I know I've seen on LinkedIn that you are in agreement with David Rosenberg's view that today's market resembles the situation in 1999 to 2000. Can you explain why you see this similarity and share advice for investors based on what we learned from 2001 and 2002 market downturn?
First of all, the real 2000 event was 2 years ago in 2022. That was the top of the market. And then as soon as they started raising interest rates, the multiplier effect of zero interest rates is infinity, right? And so the speculative money went to excess. I mean, we saw stocks like, Zoom go to $500 a share, now $70 a share. Peloton go to $165, down $5. DocuSign, which everyone uses, went to $325, now $40 a share. So the bubble top was back then, okay? Now we're in a situation where the reality is really starting to set in. But the overall indexes are masking that because of the large mega caps, the seven, the Microsofts, the Apples, Tesla's up till just recently, Nvidia's and that. These things are masking the indexes, because if you actually look at the breadth, the S&P is actually down lower than it was 2 years ago. And you start looking at the wealth destruction that's taken place in the equity markets. I mean, most people don't know, for example, that Disney's down 50%. The auto stocks are down 50%. Bank of America and Citi, as we speak, are breaking new lows now. And so the deterioration in the breadth is taking place, but the indexes are staying high because of a small basket of companies. 8 companies or 7 companies make up 35% of the S&P 500. On top of that, you have the ETF flows that are still spraying into these indexes because of these big caps. And so the ETFs are also masking the deterioration in the breadth of the marketplace. So Rosenberg is right. What we're seeing now is we're starting to see the financial risk moving forward with the recession coming. and again, most people are questioning whether there's going to be a recession or not. I don't see how you can't, because the Fed balance sheet's still at $8.5 trillion, deficit at 33 trillion, up 2 trillion this year. Interest costs are going through the roof. Consumers are feeling the pinch. What's saving the U.S. consumer right now is a 30-year, 2.5% mortgage. If it wasn't for that, I'm not sure, where the situation would be. But one of the questions I ask investors is, who are the buyers of that 30-year, 2.5% instrument? I mean, who's committed to buying a bond in essence with a 2.5% yield for 30 years? What's the value of that today? Well, you know for a fact that Fannie Mae is one of the big buyers, and that's backed by the Federal Reserve. We also know that pension funds and life cos have been buying that too. So you tell me how well they're doing moving forward with the 2.5% yield on a 30-year bond. They can ride to maturity, but what's the value of that?
Very interesting points. You said a lot there, definitely a lot to unpack. Something that I do want to shift to, though, is, I recently read Clear Thinking by Shane Parrish, and one key takeaway that I read about was, success comes down to positioning, when it comes to not only an investor, but in life and kind of many things. So when we proper position ourselves, it allows us to master our circumstances. And so a question I have for you is, what does that mean for you for investing? And how do you position yourself to take advantage of the right opportunities? What is proper positioning as it relates to gold and commodities?
Okay, it's interesting because, I think one of the biggest lessons I learned in investing was in 2002. When, going back to Rosenberg, he saw the economic situation unfolding. And I was pounding the table. Gold was at $350 an ounce and no one was paying attention. The US dollar, I saw it going into a bear market. And we kept on buying and buying and buying the equities and no one was paying attention. And so going back to positioning, sometimes opportunities come along that are so low risk, so high reward, but nobody's paying attention because everyone's looking the other way. And so when I see opportunities like that, that's when I actually really roll up my sleeves and start doing interviews like this, because this is a time when people need to listen to somebody who has the experience and the knowledge and I guess the track record of navigating through those periods. The positioning right now is key. Most people have been buying the dips for the last 2 years and they're down significantly. And most people are in the financial stocks because they think that's the place where you have to be. And yet, as I said, you start looking at some of these financial stocks. And in Canada, for example, the average Canadian bank stock is down 30%. The average person doesn't know that. So right now, more than ever before, I think positioning is very, very, very important. And again, what I provide to my clients is a portion of their portfolio. And it's an insurance policy. You don't want to sit there and run out and get house insurance or fire insurance the day after your house burns down. And I'm not a doomsdayer by any shape or form. I'm just saying that there's a lot of risks out there. Now we've just added the risk scale with what's happening in the Middle East. But you already had the Ukraine, you had the Middle East, you have the financial risks, you have the autocracies versus democracies. And if you're concerned about your US dollar exposure, US assets, you should be positioning yourself with a precious metal portfolio as a portion of your net worth to protect yourself. It's just smart business, smart investing.
Absolutely. And this actually kind of reminds me of, Warren Buffett, when he positioned himself, to take advantage of the dot-com crash, he was willing to look like a fool in the short term to win in the long term. So he positioned himself, right? So then no matter what, he won, right? So it makes me think of, right now, if we think of gold and commodities, it's unloved, right? No one loves it.
Totally.
It's hated. There's a lot of individuals that say, oh yeah, this is just another story, a hopeful story that gold will thrive and do well and perform. But it's the best time to be investing because no one loves it, right? To be that contrarian.
Well, let me just touch on, no one in the Western world loves it. I'm going to remind you that gold right now is $2,000 an ounce. It's been in this range now for over a year. It's one of the best performing asset classes out there. Last year, bonds were down 18%. Equities were down 18%. It's the gold equities that have come off significantly, and in some cases, rightly so, because they haven't performed. Other companies have done extremely well. But the Western world and the Eastern central banks understand gold. So it's in the Western world, they don't see what, it's not even on the radar. No one even talks about it. And so it is performing, it's doing its rightful job. I mean, and go back in time, and, simple question. If you took $100 in 2000 and had it in US dollars, you took $100 and bought gold in 2000, what's the purchasing power of those two instruments in comparison to each other? Your $100 purchasing power from 2000 is probably what, $30 now? $100 of purchasing power on gold when it was at 300, gold's at 2000. So it's served its purpose. But entering the world where we are right now with the financial risks we see coming forward and the geopolitical instability and the autocracies versus democracies, I just ask you a simple question. If you feel comfortable moving forward of these not being a risk to your portfolio, then continue on with your investment strategy. But if you're concerned about these moving forward, gold and gold equities has to be part of your portfolio.
Gotcha. And then that also makes me think, we've just spoken about gold, right? And I know you're more specialized than not only in this area, but also other domains of, silver and base metals. So my other question is, I'm curious to ask, how do you see there being a future performance as well as big demand, for those, investments as well?
Well, copper is a very interesting one. Copper traditionally has carried the name of a PhD in economics. As copper goes, the economy goes. But that's changed dramatically moving forward here, because now it's a supply side issue, and it's also a demand side issue with the electrification of the world. And so copper, one of the big problems in the metal space overall, whether it's precious metals, base metals, is there's not been a big capital spend to expand supply. The big mega projects aren't being built anymore. And so from a copper perspective, I mean, down in Chile, which is the #1 copper producing country in the world, when they first started mining those deposits, they were 1% or 0.75% copper grades. Now they're 0.25%, and they're deep down in the pits. So supply is a huge problem moving forward. And to put copper mines into production, the CapEx is minimum $5 billion on these projects. And so supply is a huge problem moving forward. And as we continue the move down the EV pattern, a lot of people don't know, but an average EV car has 180 pounds of copper in it. And so copper, to me, I just think right now we have a global slowdown that's taking place. And that's one reason why the copper stocks have all come off about 30% here in the last 6 months. It's setting itself up for another great buy opportunity. I'm not sure where that price is going to be. It depends on the narrative. It depends on, where the U.S. economy goes, if it's a soft landing or a hard landing. But I'm monitoring that very, very closely. And on the silver front, silver is a byproduct to a great extent. And, silver is very much a component in the EV movement as well. And then you have solar panels as well, which is, silver oriented. And then from an investment perspective, silver is a poor man's gold. So silver will perform as an asset class from an investment safe haven, as well as gold continues to go higher here. And so there's multiple reasons why silver is going to go higher here as well. But from the silver perspective, there's just a very finite amount of companies to gain exposure to the silver space.
I appreciate that answer. And, they often say, silver usually follows gold too, right? So once gold really shines, silver will then follow and probably outperform, right? Typically based off of history, right?
Yeah.
Okay. But something that I want to touch on, really interesting that you spoke about copper and the fundamentals. There's two individuals that I know of. One of them is Robert Friedland, as well as Nikki Abshabel, who I think do a very good job at educating about copper and its future. What are some other names of individuals that you highly respect, who are currently speaking and educating people about copper?
Well, the Lundin Group is this first one comes to mind. They've been speaking about this for a long period of time. In fact, 3 years, 2.5 years ago, we were up for lunches talking about how copper is being missed in the narrative of the EV movement because lithium and cobalt and all these things, other things were getting the narrative. And it wasn't until actually Jeff Currie, who's the metals analyst for Goldman Sachs, came out and made the comment a couple of years ago that copper is the new oil. And it was a very interesting comment because copper is an EV metal. And so the narrative is there now. And people like Robert Friedland, I think, does the best of it. I mean, I watched an interview with him and he's in a studio and I loved it because he basically just stopped everyone and said, look, everyone look around here. If it wasn't for copper, you wouldn't be shooting this. We wouldn't have the lights on. The film wouldn't be rolling. And he puts it in perspective that everyone can relate to. And so again, I think he's probably the best statesman of the industry. And but again, from an investment perspective, I mean, I think the big thing that people are missing on the copper front is there's just nothing coming down the pipeline. So even if you hold demand constant, supply side moving forward, and it's not like you turn the taps on. I mean, these projects cost a lot of money. They take a lot of time to put them into production. And in the United States, for example, I was down in Arizona recently, and because again, they're caught up in this EV save the world environment, they don't want to mine copper in their own backyard, which is a huge problem moving forward because a lot of the copper mines being built right now are in Russia or they have China relationships. China has a lot of offtakes out of the DRC. China is continuing to build relationships in South America where a lot of the copper deposits are. And the US is not willing to mine copper in their own backyard. And yet they're going to have to because copper is an integral part to their EV movement.
I love that you have pinpointed, the EV movement, but also on top of that, the fact of the thing that everyone tuning in right now could relate to, which it's fundamentally in everything that we do in everyday life, like in terms of the cars that we drive, you need copper, or devices, or the list goes on of everyday use of that, specific metal, right? But something that I want to shift to is I want to go back to some timeless, insights or wisdom, because I feel like you have a lot to share. And one of them is, I know you're big on narrative economics, and I think this is very important for investors that are listening right now to kind of tune into. And one of them is, when we think of the view of it, of narrative economics, driven by social media or, even like the herd mentality, everyone follows the herd. What are some strategies that you employ to avoid falling into the trap of chasing trends?
Well, yeah, just go back on narrative economics for a second. Narrative economics has led to basically investor strategy. And because people inherently are followers, not leaders. People are typically not contrarians. People want to do what everyone else is doing because that way they feel comforted with the community. And so narrative economics is driving money flows. And I've given numerous speeches on this. And, I go back to the top of the market where I think it was Pizza Hut or something like that. All of a sudden they were talking about, the digital business of Pizza Hut. And so all of a sudden, the ETFs, the digital ETFs, started adding Pizza Hut to their stock buy portfolio because now they're a digital company. I remember listening on CNBC and listening to an analyst, and I think it was Pizza Hut. The stock was trading at 54 times PE multiple, and the guy interviewed him says, "Well, Pizza Hut's a food company in that." He said, "No. Now it's a digital company now too." So the digital attachment to Pizza Hut led to money flows on the ETFs that set the stock to a valuation matrix that made no sense. So my point here is that narrative economics tags money flows, and those money flows largely come through ETFs. Most people don't realize this, but 85-90% of the volumes in the marketplace are ETF money flows. They're all algos and quant programs. The real investor isn't playing in that arena anymore. They're buying ETFs. And the ETFs are driven by narratives to a great extent. I was listening to an independent brokerage firm president about a year and a half ago, actually a year ago, and he was telling on CNBC that the number one trading instrument amongst day traders in his brokerage firm, where more sophisticated investors, was buying call options, daily call options or put options on ETFs. So they're speculating on trading momentums of ETFs on a daily basis. And that was the number one trading vehicle. So that money flow, is it driven by economics? No, it's been driven by other algos that are driving things, and narrative has so much to do with it. So the lesson to be learned is that when narrative is excessive, be wary. When narrative is non-existent, be opportunistic.
So would that also apply, like when I think back in 2020, in the summer there, let's just say the gold and commodity space was ripping, it was performing very, very well. In fact, extremely well. And, if you were, investor in the space and you had got in early, or you were hopping in, early enough before kind of peaked and came back down, would that also be a situation of an example of, when the narrative is strong, that investors are now aware of it and now they're looking at it?
Well, 2020 was different because it was a COVID situation and the Fed was QEing. Okay. So when they're QEing, that was fueling the system, and gold does extremely well in QE environments. The narrative towards the gold and gold equities was not very strong at the time. It was just more COVID and QEing, because if you look what happened, a lot of gold stocks actually topped out in 2020. Then after that, as people settle into COVID, all of a sudden the stay-at-home purchasing power took place. And so all of a sudden Restoration Hardware goes from $90, hits a high of $740 a share. Zoom stock goes to $500 a share. Peloton goes to $165. So the narrative became, you're at home, you're locked down for 2 years with COVID. What are you doing with your spending habits? And then once COVID finished, so that was the narrative then. Then once COVID finished and people started coming out again, then it became lifestyle. People going to restaurants, traveling, hotels. And so the consumption function went from stay at home, buy Amazon, buy Apple products, buy all these durable goods and that, improve your home improvements in that, to lifestyle and experiences. And so that's why the narrative went into those, and rightly so, because that's what people were doing. And yet now everyone's talking about, everyone's out traveling, you can't get hotels and airlines and that. Well, that was back. Looking forward right now, a lot of the airline stocks are down 30-40%. The other day, Vail Aspen Corp stock dropped 20% in one day because people have spent. They spent. Now they're realizing their savings function is being diminished, and now they're starting to cut back. So again, going back to narratives, the narrative was stay at home, buy Restoration Hardware furniture, and the stock goes stupid. Now Restoration Hardware stock is $220 a share, down from $740. So, but there was such a concentration in the investment world towards those sectors. We still haven't seen that concentration towards the precious metal sector. We saw it in copper, for a period of time there. And then, of course, copper stocks ripped a few months ago because the speculation that China was going to stimulate. And so the copper stocks took off and they went up 30% in like a month. But China hasn't yet. And their problems they're still waffling around in their real estate problems. Unemployment amongst the youth, males, is 22%. So, but again, narrative can mask the reality because social trends and media trends trigger human behavior.
Absolutely. No, it makes a lot of sense. And do you think there would be, narrative that would help gold and silver at some point?
Well, yes, for a couple of reasons. And there's no question, Bitcoin stole a lot of thunder that could have gone into gold. There's no question about that. But as I say that, gold is difficult to buy, difficult to store. And so what your readers may not be aware of, it's been 2.5 years in the making. The World Gold Council has been working on the development of a gold-backed stablecoin. And we're getting very close to that. And so the barrier to buying gold and storing gold is going to disappear. And so you're going to see a stable coin in gold that is digital and it's stored. Okay, so when you buy your digital gold, it's sitting in a vault in London, England, for example. And this has been 2 years in the working. And the reason why it's taken so long is because you need to make sure you have 100% authenticity of the purity of your gold. Otherwise, you invite potential scandals of other servers trying to provide this product. So about 1.5 years ago, the LBMA and the World Gold Council collaborated. And since then, they've got the big bullion banks on side. Now they're getting the financial houses on side. And so what you're going to see is a narrative where gold's being brought into the 21st century. So then, whether it's 2 months or 6 months or a year from now, not that I wanted to have a debate between Bitcoin and gold, but you look at Bitcoin at 30,000, gold at 2,000, and you look at the value of each one of them, and you run the risk of having your envelope stolen in Bitcoin, and you got a tangible stable coin that you buy that sits in a vault, and you can buy it readily on your phone. Is that going to be attractive? And so the narrative conversation will come about. And I think as that happens, people will be educated about gold's history, gold's role, gold's importance, because a lot of people don't know that in the Western world. BlackRock just embraced an ETF to buy Bitcoin. And that's one reason why Bitcoin's done so well here. And Larry Fink, head of BlackRock, which is the largest asset manager on the planet, being interviewed a couple of months ago, you could see where the segue was going into the ETF for Bitcoin. That's where the conversation was going to end. So they talked about the economy at first, et cetera, et cetera. Then, unprovoked by the interviewer, Larry Fink said, gold has traditionally been a reserve currency independent of fiat currencies. But the problem with gold is it's difficult to buy and it's difficult to store. And from that, he segued into the validation of why they're embracing an ETF on Bitcoin. Well, fast forward 6 months from now, Larry Fink's then interviewed. It's no longer difficult to buy. It's no longer difficult to store. So this new product that the World Gold Council is coming with is bringing gold into the 21st century. Now, will that be attractive to investors? I can't see how it can't be.
Super interesting, Cam. I love that. Thanks for sharing, that info. I'm sure my listeners have really, appreciated that. Something that I want to follow up with next is I've shared with you, before we hopped into this interview, that I'm very big on mental models, that are frameworks, to help investors make more intelligent decisions, because they can be very emotional. It's kind of human nature of us, right? So I'm a big believer if we have a lot of mental models in our toolkit, we could hopefully make better decisions and less mistakes. And a lot of this was kind of founded more by the concept of, Charlie Munger. He kind of was one of the ones that was really talking about mental models. And so, question I have for you is, what are some mental models, in your investing toolkit that you use, to make more intelligent decisions, whether it is, your circle of competence or probabilistic thinking? What are some mental models that you use?
Well, first of all, Charlie Munger, I think he's one of the best investors of all time. And one of the things that I think he touched upon is, he views diversification as a not an effective way of doing things. Because if you're fortunate enough to find 4 or 5 or 6 companies in your lifetime to stay with them. And now in the mining business, it's a very different business because it's cyclical. There's a lot of elements that can come against you. So keep in mind, I'm talking to the audience, that I'm only dealing with metals and mining as a space. But I also monitor a lot of what's going on globally, politically, economically. I have to understand, where we are. And so I think the number one mental model is that, just stay with the best pedigree, right? A lot of people get lured by shiny objects and that's one of the challenges. And that's one reason why, I work with high net worth individuals, because a lot of people who know nothing about the space can read about or see opportunities that are very misleading. And it's, the mining space is a very difficult space to navigate. You have a lot of geopolitical risks, economic risks. And, I've been, as I've said to people, I've been 99% right, 1% wrong, and lost a lot of money because things come at you out of left field. And that's just the mining industry. You may have a political change in a country, because unfortunately, a lot of these assets reside in countries that are developing nations, right? Or you have, I was involved with a project in Canada that had caribou politics, and it impacted the stock for over a year. It was unforeseen. It was a permitting issue, right? So having a basket of companies is absolutely important, and they're tailored to your risk profiles as well. You can buy the seniors, mid-tiers, developers. A number of my seniors right now, or mid-tiers, are paying me 3-4% dividend yields, and they're debt-free. And so having that mental mindfulness about the companies is one thing, but also being aware that, that there are risks and you are going to have losses in a mining portfolio due to unforeseen situations. You can't pick up and move your deposit. And that's one of the things you have to recognize in the mining space.
Absolutely. No, it makes a lot of sense. But then how can an investor, who's tuning in right now, they probably don't have the same circle of competence of you in terms of like connections in the space, whether that's fellow investors or fellow CEOs, and the people is huge, in any business, but especially in like the mining business, in terms of success, right? And if we think of, the Ross Beatties out there, not every investor tuning in right now has those personal connections, right? So how can an investor that makes the decision that they would like to invest in the space because of the macro picture, because of, the strong fundamentals, how could they, properly, do their due diligence to position themselves in the space?
Well, first of all, you don't do it yourself. I mean, it's like me going in and, into a hospital and trying to do brain surgery on myself. It's a stop from the beginning. And that's why, Metals and Mining, Currie Metals and Mining Group, which, by the way, we're our group, but we're really an extension of the Canaccord Genuity mining team. So I have an arsenal of my entire team as part of my package, on top of all my clients and corporate relationships and institutional relationships and the global relationships. So why would you try to navigate that yourself when you can go to somebody that's already done 35 years of work and time and has a deep relationships? It's just smart business, right? To try to navigate the sector, that's one reason why people stay away from the sector, because so many people lose so much money because they try to do it themselves. And you just can't do it. It just doesn't work.
I really appreciate that. Very simple advice. Thank you for sharing that. A question that leads up from there is, you have a lot of experience in the space, 35 plus years, but also as an investor, just in general. So a question I have for you, you've worked with some pretty high profile investors as well. What do you believe separates a good investor from a great investor? How does someone go from good to great?
Well, I think one of the things I alluded to before is that sometimes opportunities come along that are so low risk, so high reward, and no one's paying attention. And just because a stock's down doesn't mean something's not doing well. And I think, like, for example, the environment we're in right now, we had gold down $200. Now it's bounced back. The seniors and mid tiers have bounced back nicely, but the developers are back where they were when gold was down $200 an ounce, because there's no money in the space, and we're seeing redemptions, if anything. And so, having that discipline to find those opportunities when people are selling for all the wrong reasons, and that takes skill, but it also takes like a word, takes balls. I mean, a lot of people follow in fear and greed, and people sell in fear and they buy in greed. And to be a buyer when everyone's in fear mode is extremely difficult to do. And as an investment advisor, trying to convince people to put money when people are losing money, it's like you have to convince people that it's a 40% off sale. And what changed? But again, it's human nature. People want to be where everyone else is. When everyone's chasing something, everyone's talking about something, then it's easy to buy that sector, because now everyone's in with you. I mean, you go back to the NFTs and, all these cryptocurrencies. I mean, everybody was talking about it. So everyone caught up in the buying of it. Look what happened to them, right? So being there and having the wherewithal to buy them when no one is there, that's the biggest challenge. And it's not easy.
I agree. You have to have a strong stomach. And, fortunately, there are some mentors in this specific space, like Rick Rule, who has said a lot of things that you just said, about why would, if nothing has changed in terms of the fundamentals and the price has gotten cheaper and is on discount, why would you not buy more if you have done your due diligence, your homework, your research, you have connections? Why would you not buy more? especially if you like something, right? But it's funny how when we think of mindset or investing emotional behaviors, how we sometimes don't do that. We do the opposite. We get scared, right? So you definitely have to have a strong stomach. And so I appreciate you for sharing that wisdom a lot. A question that I want to go to, Cam, is, as you know, the purpose of this podcast, is to inspire millions of people across the world, to achieve greatness and enhance their overall personal well-being. We could be financially well, but we could be not emotionally well. We could be physically well, but we could be not intellectually well. So a question I have for you is, what is your definition of greatness?
Wow, that's a big question. I guess one of the foundations that I'm built off of is my principles, morals, values, and ethics. And if I were to look at a foundation of greatness, those are them. And I think, every morning you wake up, doesn't, because in my business, I mean, we've had bear markets that have been terrible. We've had bull markets that have been phenomenal, and each one I learned from. But one thing is that you wake up in the morning, you look in the mirror, you like who you are because you've tried your hardest and you've been honest with integrity and passion, and that's a perpetual learning curve. The last 2 months when gold was down $200, because the Fed was hawkish and the US dollar took off again, that was an uncomfortable period, but I was doing the best I could do. And I was constantly going back and rechecking my thoughts and my analysis of my companies, because in corrections like that, it forces you to really dig deep into all your thoughts, your personal thoughts, your mentor thoughts, your economic thoughts. And that's, to me, in a lot of ways, is greatness, because you're actually very engaged and alive. And greatness involves going through hard times. And but when you actually give it your best shot, and again, going back to principles, morals, values, and ethics, that's everything. Because the thing about our industry is greed can dissuade a lot of people. And I think there's 10 times more sociopaths in the investment world than there is in the average industry. And it attracts, dysfunctional people that are there for the wrong reasons. And staying the course and staying separated from those people and not letting those people affect your being and your thought process is one of the challenges. But that's, again, is, it's how I roll, because, I represent the values that I represent. That to me is greatness.
I really respect that answer there, Cam. Powerful definition in terms of, being very values based as a person, and living by those principles and stuff. So huge respect to you. And, a lead up question, that I have for you is, now that you have a good feel of my podcast, and my show and kind of what it's all about, who is a future guest, someone that personally that you would love for me to interview on the show?
Well, there's many. But, I've covered the precious metal space, and I've mentioned before, but, Adam Lundin, I think, would be a great person to have, because he's got a very, very big macro perspective. His values and principles are aligned with mine. And he's one of those rare people that stands for the integrity of the industry. And there's a lot of them, but there's a lot of people that are there to make self-wealth. And his philosophy is everyone wins, and to grow success, and then the derivative. And that's one of the things for myself too. Financial reward is a derivative of success. And so if you're successful in building companies and unlocking values, the derivative is your financial success. But the reality is, the real reward is building success. And Adam is that type of culture.
That's great. Well, I really appreciate, that recommendation, and, I will do my best, to bring him onto the show, to unpack another quality-based interview. Last thing, Cam, before we kind of sign off today, you've given a lot of valuable insight today, but, where is the best place, for people tuning in right now to either follow your work or connect with you online?
Well, if you go into Google and look up Currie Metals and Mining Group, you'll find us. We're at CG, Canaccord Financial, And the clientele I work with high net worth and family offices. I specialize in the sector and tailor portfolios for your investment needs. So feel free to reach out and set up a Zoom call.
Awesome. Great, Cam. So I'll be sure, for who's tuning right now, I'll be sure to put those UR links in the show notes. And yeah, awesome. Thanks so much for everything that you've done today, Cam.
Well, Ben, great interview. I love the openness of it all. And again, if you want to reconnect in the future for further dialogue, please reach out. Thank you.
Awesome. I'd love that.